Thank you. Good day, everyone, and welcome to the Apar Industries Q3 FY22 earnings conference call. Today on the conference, we have with us Mr. Kushal Desai, Chairman and Managing Director, Mr. Chaitanya Desai, Managing Director, and Mr. V.C. Divakar, Chief Financial Officer, Apar Industries. I would now like to hand over the call to Mr. Kushal Desai for his opening remarks. Over to you, sir.
Yeah, thank you, Nitish. Good afternoon, everyone, and a very warm welcome to the Q3 earnings call of Apar Industries. I would like to start with an overview of our performance and then follow that up with a few bullet points on key industry updates. And then I would like to give some details based on each of the three segmental performances that we have. Post that, we can open the floor to questions. So looking at some of the key macroeconomic indicators, they were gradually getting steadied in the first half of FY22. And right until December, when we had some of this Omicron variant coming in and upsetting some of the inspections and dispatches just towards the last few days of December. Even though there has been a bit of a stalling because of that and a challenging international freight environment, which has been affecting the growing export business that we have, Apar has delivered relatively a steady performance in this quarter. Overall consolidated revenues for Q3 FY22 came in at 2,235 crores, which is up 32% year on year. Of course, this has been helped by some of the increases in commodity prices also, and it is 22% higher than the pre-COVID levels of Q3 FY20. This has been largely driven by a 40% increase in the domestic business. Exports contributed to 35% versus 40% in Q3 FY21. The EBITDA for the quarter came in at 127 crores, which is about 5.7%. Profit after tax came in at 55 crores, which is up 50% from the pre-COVID levels of Q3 FY20 that had a 2.5% margin. Last year, of course, we had a very poor first quarter because of the lockdown and then a catch-up taking place in the subsequent quarters. If you look at the 9 months FY22, the consolidated revenues came in at 6,328 crores with an EBITDA of 393 crores, which is 24% higher than the previous year. The EBITDA margin stood at 6.2%. We continue to focus on the premiumization of our business mix, and with some reduced financial costs, helped both by working capital discipline as well as reduction in the interest rates. The profit has remained at a reasonable level, and the consolidated PAT for 9 months FY22 came in at 174 crores, which is 56% higher than the pre-pandemic period of 9 months FY20. I will now cover a few industry highlights as such. The outstanding dues of DISCOMs continue to rise, unfortunately. It's risen 4.4% to 1,21,000 crores as of December 31st. A fallout of this is that DISCOMs continue to postpone the finalization of tenders for some of the power infrastructure. Especially, we've seen a very low demand for distribution transformers as such, which in turn has had some effect on the transformer oil market and performance of our oil division. We've seen 10,600 circuit kilometers of transmission lines which were added in the 9 months FY22, so that's 17% higher than the same period previous year. Transformation capacity addition came in at about 54,928 MVA, which is 81% higher than the previous year. The government has approved 12,000 crores of a green energy corridor, phase 2, which targets the addition of around 10,750 circuit kilometers of transmission lines and 27,500 MVA of transformation capacity, substations and other equipment. The key T&D players have reported an order inflow of about 13,000 crores in Q3 FY22, almost doubling from the previous quarter. But still, if you consider it over a longer period of time, the number is relatively muted compared to the projections which have been indicated by the government. The Indian Railways is on track to achieve a $15 billion capital investment by March 22 to enable the investment-driven recovery, and it has also announced that it's aiming to be a net zero company by 2030. As per ICRA's latest bulletin, India is slated to add about 16 gigawatts of renewable energy capacity in FY23 as compared to around 7.4 gigawatts in FY21 and 12.5 gigawatts which are expected to be in FY22. Our expectation is that the wind energy capex will substantially increase, and if this happens, then the expansion which we plan in our cable division for producing cables that go inside windmills will be quite well timed, and if we are able to fulfill this requirement, then it will give a major fill up to this project. About 70% market share is what we have for cables which are used within the windmills. I would now like to move over to the segmental highlights. So we'll cover the conductor division first. So conductor division's revenue in Q3 FY22 grew 27% year on year to reach 939 crores, which was driven by a 73% growth in the domestic business. The export business here was impacted due to delay in order execution from logistics and inspection, and some of the projects being postponed by the clients due to the higher commodity prices and logistics costs. So here we have tentatively quoted a price based on a certain London Metal Exchange rate for aluminum, and the customers, once they finalize the rate, the final prices are then settled. So in many of these cases, since it's well out of the original budget that they had, some of these have been postponed. Exports contributed to 29% versus 50% in Q3 FY21. The higher value products contribution increased to 44% from 34% in Q3 FY21. The HPLS and high efficiency conductors revenue was up 55% year on year, contributing to 18% versus 15%. And revenue from copper conductors for railways was up 96% over the same period previous year, and it contributed 17% of the revenues versus 11% in Q3 FY21. So the EBITDA per metric ton post adjustment recorded a historical high for the second consecutive quarter at 16,987 rupees per metric ton. So that's up 46% over the same period previous year. Consecutive quarter, at 18,987 rupees per metric ton. The new order inflow came in at rupees 1,886 crores, which is also up 80% over the same period previous year. The total order book remains healthy at 3,078 crores, which value-wise is the highest order book that we have in the last 5 years. It is up 45% year on year, with 54% of this order book coming from the more premium offerings. With increased competition for conventional conductors in the domestic market, we continue to remain focused on improving the business mix towards a higher share of premium offerings as well as selected export markets, and this is clearly reflected in this current order book which we have. In the 9 months FY22 period, the conductor revenue came in at 2,697 crores, which is up 30% year on year. EBITDA post forex adjustment per metric ton came in at 16,863, up 63% year on year. The new order inflow in this 9 months has been 4,314 crores, which is up 99% over the same period previous year and is also a historical high for us in terms of order booking in a 9-month period. As I mentioned, this is aided to some extent by higher commodity prices, but not to take away from that, the product mix has also improved in favor of HTLS as well as OPGW and some of these higher value products. Now coming to the oil revenue side, the oil revenues in Q3 FY22 came in at 905 crores, which is up 31% year on year and 54% from the pre-COVID levels. The volumes have remained relatively flat. And here we've had some amount of impact due to higher freight in exports as well as foreign exchange issues in some of the larger target markets which we have, like in Africa. The export contribution came in at 42% in Q3 FY21. The Hamria plant ran at a slightly reduced utilization at 83% in the quarter. White oil sales volume was up 4% year on year, whereas transformer oil volume was down 16%, largely due to a weak domestic demand, which I mentioned earlier, has been emanating from lower tenders for distribution transformers. The lubricant business revenues came in at 199 crores, which is 11% higher than year on year. The industrial oil volumes were at 4,800 KL for the quarter. Automotive volumes, however, reduced by around 26%, partly due to a slower retail sales as well as a substantially lower demand from the tractor OEMs, where we do have a concentration. The EBITDA per KL post adjustment continued at a healthy level of 6,743 rupees per KL. So that's up 119% from the period pre-COVID of Q3 FY20. The second half, FY21, that is in the last year's second half, the oil segment had a historical high given the acute shortage of base oils, which allowed for the highest pricing and margins that we had ever in the history of the company. After the supply chains have been restored in this 9-month period, the performance has been more in terms of a steady state. And it's representative actually being higher than the 5,000 rupees per KL, which is our targeted margin. It's been higher at 6,743 rupees. As we navigate the fourth quarter of FY22, there may be some challenges from higher crude prices, which are at a 7-year high. This is also getting added in terms of base oil prices and an expectation that in the budget the increase in the custom duty for base oils, which will be effective from May of 2022 onwards. And also there has been elevated freight for exports. But the silver lining for us is that we have inventory which we are carrying at competitive price levels, and this should help cushion the effect in this fourth quarter of FY22. Further, in the 9-month period, the oil revenues have come in at 2,632 crores, which is 60% higher than the same period previous year. The volumes have increased in this 9-month period by 17% at 3,44,568 KL. The EBITDA per KL post forex adjustment was also at a good number of 6,472 rupees, which is up 6% year on year. The diversified product offering as well as the geographic spread have enabled to steady the performance for the oil division across this 9-month period. Now I come to the cable division, which has had the maximum impact in the third quarter from a negative standpoint, where the revenues have come in quite healthy at 486 crores, which is up 51% year on year and 24% over the pre-COVID levels. We have an unbilled revenue of 121 crores of exports, most of which are in transit to the United States and to Australia, which are both far off markets, and these are on a DDP basis based on the negotiated terms. The export business is at around 35% in this quarter versus 16% in the same period previous year. The XLP business in India still remains competitive, but the light duty cables, which are sold through a distribution setup in a B2C sort of environment, has been improving for the company given the greater focus that we've had. So the value in this segment, though small, has grown from 17 crores in the quarter a year ago to 32 crores in this quarter. There is a continued focus to expand the retail distribution and increased local and digital branding activities which we have commenced. The EBITDA margin post FX came in at 3.2%, and here there was an impact of 75 crores of orders which were executed at a negative EBITDA of 13 crores, and these were largely due to effects of higher freight, increase in certain polymer prices and other raw material costs. So in this particular quarter, we've actually taken a fairly large hit on the chin and executed a large portion of orders which seem to be relatively unfavorable. So that, along with this 121 crores of export and transit, have both impacted the bottom line negatively in the way in which the accounting systems are required to be followed. So the impact of this 75 crores of orders that we executed with a 13 crore EBITDA, 13 crore negative EBITDA, has impacted the EBITDA for the quarter by about 4%. Demand for cables in the renewable energy installations and execution of orders for defense as well as the railways, that is the rolling stock cables, will benefit in the fourth quarter of FY22. There is a reasonably good amount of execution that is expected to happen in this fourth quarter of these products. Looking at the 9-month FY22, the cables revenue came in at 1,310 crores, which is up 59% year on year. Focused export strategy has driven export revenue to grow by 140%, and its overall contribution is 28% in the 9 months versus 18% in the 9 months previous year. The EBITDA margin post forex adjustment came in at 4.4%. The benefits from higher sales in exports so far has not really been fully realized because of the higher freight costs that we had to pick up in the previous period. The company plans, however, to continue to focus on these opportunities over the next several years, as it is a very attractive long-term opportunity, even though there has been a temporary setback due to freight. However, export orders which are now being booked are at the current freight levels as well as at the adjusted raw material prices of today. So in summary, we expect the fourth quarter FY22 with a healthy order book both in the conductor and cable business. Our program of improving the premiumization of products and focusing on the export business will definitely show positive results. These initiatives have a long-term positive impact on the business. Also, the growing B2C part of the wires and lubricant business, we continue to invest in that, and we are sure that there will be substantial growth coming from those segments in FY23 and FY24. So with this, I'd like to come to the end of my comments. I would also at this stage like to mention and felicitate Mr. VC Devatkar, who has been the CFO of our company, and he's completed a long innings of 27 years with Apar in various positions, finally culminating in the position of CFO. He is due to retire on 31st March, and his successor, Mr. Ramesh Iyer, is also on the call at this stage, listening on the call. And so we wish Mr. Devakar all the very best, and like to welcome Ramesh Iyer to the company. So with that, I'd like to come to the end of my comments. Thank you everyone for joining the call, and we may now open up the floor for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Maulik Patel from Equirus Securities. Please go ahead.
Thanks for the opportunity. Couple of questions. On the cable side, you mentioned that this one order which contributed to the negative EBITDA. Do we have any such more orders? Are there in the order book?
So, Maulik, it's not one order. There were a few orders which were picked up in the early part of the pandemic when everything had fallen substantially.
Sure.
So there were some. A large portion of what was clearly identified by us has been actually taken in this quarter. So there are a few more orders where we do have negotiation going on with customers on the freight side.
Okay.
But you will not have such a big negative impact happening.
Okay.
The way there's nothing that we see that would have such a big impact. It so happened that we tried, we cleared all these off, to try to keep as clean a slate as possible, going forward. Because the commodity price regime still seems to be, following an inflationary trend. So the sooner that we got this out of the books, the better. We thought it was more prudent.
Okay. And cable has been under any severe pressure. If you look at from the margin perspective, the other two businesses have recovered fairly substantially, though, and the premiumization strategy is also working. But in cable, the margin which we used to have around 9 to 10%, and even if you look at on one of the best margin what we did post pandemic has been in the range of around 6%. So is it because of this too much of competition in the market, or is that because the orders which you are getting it is more about of the commodity product and less on e-beam cable or some specialty cable?
So let me answer that in two parts. We had seen that the competition in the domestic market would be reasonably severe, especially coming from EPC contractors and utilities, and that's why we decided to focus on the export markets. Including trying to capitalize on the China Plus One strategy. Now, from a qualitative standpoint, that has worked because out of this 121 crores, 90 crores is in transit just to the US. And a chunk of the remaining is in transit to Australia. So, we've managed to get into various new accounts there, etc. But because of the freight impact primarily, some of these margins have got eaten up. So that's one factor. The second factor is that the defense part of the business has been very slow, during this whole pandemic period. Okay. And that is a very profitable segment for us. Even though it's about 5-6% of the revenues, the margin and profitability on the business is quite substantial. As we go into Q4 onwards, we are seeing some of that coming back on track. It has taken a very long time for it to fall in place, but the pace seems to be now picking up. So that's the reason why in my opening comments I specifically mentioned that in Q4 we will find, that some of the defense will play a bigger role. The third thing is that even though we are a large player in the solar, the PV, the photovoltaic, cable side, that is, there are a number of players there, and that is a little bit more competitive compared to the cables which we supply that go into the windmill.
Okay.
So the wind side has been a little bit slow, but again now that has started picking up, and we see a much better offtake in Q4 as well as an order book, on the wind side coming up thereafter. Especially since many of the tenders which have been floated in the last couple of years are not just pure solar, but they are hybrid, which has a combination of wind and solar.
Okay.
So I think going forward on the cable side, I know the current Q3 numbers are very disappointing. But if you add back that 13 crores for the quarter, the profitability would be at 7.2%. At the end of the day, of course, one has to take into account bad orders also, but I'm just as a matter of reference. And the revenues going to the US at 121 crores is almost 20+% of the revenues that would have been there if they had been billed. Now these contracts are on a DDP basis, and that's the way the US market runs. So you find that in this quarter you have a larger portion of unbilled revenues. In future, if this level of business continues, it will go into a rolling cycle. So you're kind of taking on a bigger hit in the first quarter, and then after that, it reaches a steady state. So a few of these things have unfortunately come together in this quarter, but in Q4, we don't see these same impacts, and you'll see a much better number on the profitability front.
Okay. One thing I have noticed that our interest cost has declined. Generally, being in the converter of base oil and aluminum, with inflationary pressure on raw material, the working capital has to move up. Is it because of your strategy toward the premiumization, the working capital is not rising proportionally to the increase in the raw material prices? Historically, we have seen that increase in the raw material prices led to the increase in the working capital and higher interest cost.
So there are two factors in here that I'll allow Mr. Devadkar to actually elaborate on this. One is that we have been fairly disciplined in terms of especially the debtor side of the equation. Secondly, we have had the tailwinds in terms of the interest rate based on the previous LIBOR, etc., which continues to be at a decent level. But the discipline on the working capital has also helped. So Devadkar, would you like to comment?
The number of days have also gone down actually. Plus we are sitting on some money actually, close to about right now you can say around 465 crores is there actually, cash and cash equivalent, money lying in mutual fund, etc. So even if, as Kushal Bhai has explained, prices have increased, so value increase will have impact on the interest, but that impact is not there because we were sitting on good amount of mutual fund, etc. And that money has been used.
Okay. And the last question, if you allow me, what's the capex we spend on this year, and what's been likely to be the next year?
We have said, as of now, we have spent close to about 65 to 70 crores.
Okay.
Our budget was 140 crores, but we have not spent the total budget actually. But 70 crores has been spent, and something we will be spending. But that 140 crores we will be spending, but it is possible that we may not be able to spend the entire amount in this year actually, if we get spill over.
And this 65, 70 CR,
the large portion of that, Maulik, is coming in from two areas. One is putting in equipment to manufacture windmill cables, not only for the domestic market but also for the export market. I mentioned on one of the previous calls that with a lot of effort, we've now got approvals from the top 5 windmill producers in the world. So we service their installations in India also, but now we've got approval to start servicing their overseas requirements. So we don't have the requisite capacity in place if we were to take it on a full scale. And secondly, we installed one electron beam machine last year, and we are installing another electron beam machine which will get commissioned around the middle of 22. So around the June, July, August time frame. So this we've taken a little bit in advance for two reasons. One is that we see again solar cables, rolling stock, defense, all of this picking up. And secondly, the retail offering that we have is of a E-beam based house wire, which is a unique, we're the only ones at the moment marketing that house wire. And the initial response has been quite good. So last year we did around 60 crores of revenues in the LDC, this building wires and light duty cables. This year we are targeting 100 crores. And the infrastructure is being set up so that in FY23 it will get closer to 200 crores. So that's one part of the business which is also growing rapidly. So some of these capexes are actually targeted towards, the more premium offerings in the cable side.
Got it. And now with this, the E-beam machine which you expect to commission in middle of 2022, you will have 4 machines, right?
Yes, we will have 4 machines.
Okay. And any capex plan for the FY23, which you probably have finalized? Any capex number?
So FY23, there is only one other, besides what is being completed on the cable side. There's one project that's on the conductor side, where we are going to manufacture in-house some components for the OPGW.
Okay.
So that's about a 10 crore investment. The rest of it is all basically just maintenance capex. So the capex plan, will start moving down. We had a plan of actually not spending this much on capex, but given these few opportunities and this whole climate change movement taking place, it was better for us to make these investments sooner than later. And I think the timing of some of these investments will hopefully show up in our FY23 numbers.
Sure, sir. Thanks. And thanks, Divarkar sir. Thanks for taking all the efforts and engaging with an analyst and having long discussions on the company. Wish you all the good life. Thank you.
Thanks, Maulik, actually. Thanks for all the support all these years.
Thank you. The next question is from the line of Riya Mehta, individual investor. Please go ahead.
So this is Pratiksha here from Apar Investment. So for the conductor segment, I just wanted to understand how do we look at margins here? Like initially a few quarters back, our HEC contribution, basically value-added product contribution was lower, and the margin standard impacted then. Now that the contribution has come up, while the EBITDA per ton has increased, margins still remain subdued. So how do I generally look at margins in this segment?
You should not look at margins on percentage basis, because when the commodity price increase, the EBITDA margin we are looking at on per ton basis as far as conductor business is concerned, and you should look at only on per ton basis only, because.
But I think the one statement which you are making that the EBITDA has increased, but then the overall margins on the conductor business remain relatively low. That is not correct. The bottom line has moved up, pretty much in consonance with the increase in the EBITDA per metric ton.
I think we've done, around 5-6% margins earlier, and that's what
I'm saying is, you don't look at it as a percentage. You've got to look at it on a per ton basis, because right now aluminum is at a historic, is at an all-time high.
Even
so copper also is at an all-time high. So a percentage is not the correct way of looking at it. You look at it on a per ton basis, because at the end of the day, the business, gets a conversion margin and then a premium for a product that is a value-added product.
Okay, understandable. So, what would be, given these, aluminum and copper prices right now, what is a good way to look at? Like earlier, we used to say that we used to target 12,500, rupees for EBITDA per ton. With these kind of commodity prices, what is the rate that we should look at? What will be our target here?
So, we're still targeting 12,500 a ton as a minimum. But we have been getting higher as the mix of particularly these high efficiency conductors, etc., have been increasing. I'll ask Chaitanya to comment on this.
Also, it has EBITDA per ton has gone up, also because we have reduced some of the exports of the conventional conductors for the reasons that were explained above. So when
Right.
that conventional business comes back on track, because now we are getting the new business at the prevailing freight rates and the costs which are existing, then that will again have a tendency to bring down the weighted average EBITDA because of the volume which is having gone up of the conventional conductors.
Okay. Okay.
So we will still target 12,500 as a minimum and try to beat that number. So I think what as Chaitanya is saying that as the conventional, because now we see people wanting to price, they're running out of time on the projects that they have, so they'll price the conventional conductor orders which were pushed out, and they'll start executing. So you will see a volume fill up taking place. So it will be accretive to the bottom line, but the per ton will then come down from the 18,000 to some extent.
Understandable. Okay, and in terms of our execution period, generally, what I understand is that the execution period is about 2 quarters. So with the order book now coming up to 3,000 crores, do we see the execution like this executable in next 6 months?
10-month orders are there actually. Right now we are having 98,373 metric tons of pending orders.
Okay.
So that is equivalent to 10 months actually.
Okay. All right. My next question is actually on oil front. So like you mentioned, I think that, with the coming quarter, impact of high crude oil prices will start coming in. And you also mentioned that there will be inventory. So generally, last 6-7 quarters, we've seen like 1,000 rupees per KL EBITDA. And then at peak, we've seen almost 10,000 rupees. So, is it good to assume that the volatility is kind of taken care of and now we'll be in a steady path of passing it over with whatever, lag that we may see?
Yeah, so I'll answer that question in 2 parts. One is that, what you've seen in the last 9 months has been a little bit more steady state in terms of availability of raw materials, and there have been ups and downs in crude. Like, you had crude going up, then it went down, now it's again come up. But the product mix has actually helped, as we've added, more volumes coming on the lubricant side, as well as, the business in the Middle East from the Hamria plant also has increased. The second part specifically with respect to, the crude prices and all that going up, what happens is that, we buy quite a lot of product on contract. Almost 70% of our base oils are bought on contract. So the contract has a lag effect, so the increase takes place slower than in the spot market. And when the prices fall, then the reverse order takes place. So my point here was that even though crude has been going up and has shot up in the beginning of this quarter, because of the inventory as well as the contracts which we run, we hopefully should not see much of an adverse impact in Q4 of FY22. It is going to give us that cushion for us to be able to handle and ease through the increases in prices to customers.
So generally, we would be able to pass on these increases to the customers also, right? So that would usually take...
Usually, we are able to pass them on. But what happens is that if your inventory levels are unfavorable in terms of the quantity as well as the price level, then you end up having a leakage. You end up absorbing, given the time that it takes for the increase to take place. But this time we feel that we have adequate amount of time available on hand to be able to, increase the prices in the market.
Okay. And if you could just elaborate on the impact of the budget amendment on import duty.
The duty on the base oil, as per tariff, was 10%, but through a notification they had reduced it to 5%. So presently we were paying 5%, but it is said that from on 1st of May, all these notifications where the exemption has been given or the duty has been reduced, these notifications will be withdrawn. We are still studying the budget actually, it has come actually. So we have to see very much in fine print also, in details. But that is what has happened, and that is across board they have done like that actually. So many products actually, the duty is likely to increase.
Okay. Lastly,
so that actually for us will be a pass-through because it actually hits everybody in the business. And the way the public sector oil companies which run the refineries here for base oils, they also price their product against, a CFR India sort of price point. The only reason for bringing it up is that actually adds to the product inflation. Because you not only have the crude going up, which will affect base and oil, in addition to that, there will be a 5% increase happening in the prices of base oils as one goes forward.
Makes sense. Okay. And just lastly, if you could get
you, ma'am. Request you please rejoin the question queue for follow-up questions.
All right. Just last thing. Best wishes to Mr. Divadkar for his retirement. It was pleasure talking to you. Thank you.
Thanks.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, we would request you to rejoin the question queue. The next question is from the line of Anand Shah from GK Globus. Please go ahead.
Hello, sir. I am really grateful for this opportunity. My question was that as you mentioned that the orders have been delayed, do you expect the orders to be delayed in the following quarter as well, or are you expecting them to fall in line?
No, we don't expect a delay in terms of order execution, because in many cases, customers had already delayed placing the orders, and that's why if you would see in some of the previous periods commentary and details, the order book had gone down to some extent. But there are certain timelines in which these contracts have to be executed, the transmission lines and things like that. So we don't really expect a delay. The fourth quarter execution should be reasonably smooth. The only thing that can derail this, and it doesn't look like it will happen in this quarter, is in case there is a further delay on international travel for some of the inspections which are there. But given the current scenario of COVID, it seems like every country things are improving as opposed to getting worse. So our sense is that Q4 order execution should be pretty much on track, both conductor and cable.
Right, sir. Thank you very much. And lastly, I will ask, what is your forecast for the conductors business in the quarter 4 and for the next year, financial year 23?
We are likely to do around 30,000 actually, as far as volumes is concerned, in the Q4, as it stands now. And we are working on the budget right now for the 22-23 actually. It has not been formed up as of now.
But I will just specifically mention a couple of things in there, that for the first half of the next year, there is a certain amount of visibility given the order book that's already in place. That order book has a good component. It's about 54% of the current order book has products like high efficiency conductors, HTLS, OPGW, and some of these rods, etc., which are more premium. So the next 9 months, the execution looks relatively good. There are more tenders and orders coming up. And the trend for these 2 products especially, which is high efficiency conductor stroke HTLS and OPGW, is only going to increase with time. So I think the outlook for conductors actually looks relatively good for next year in general.
Right, sir. Thank you very much.
Thank you. The next question is from the line of Nimish Shah from MK Investment Managers. Please go ahead.
Yeah, thanks for this opportunity and congratulations for a good set of numbers in this challenging times. So I had questions related to the conductor business. So like you mentioned that the order book for the next 9 months, almost 54% is
Mr. Shah,
comprises.
sorry to interrupt you. The audio is not clear from your line, sir.
Hello, can you hear me?
Yes, please go ahead.
Yeah. Thanks. I had a question on the conductor segment side. Like you mentioned that the current order book, almost 54% of the orders comprise of the premium products. So just wanted to understand the coming pipeline. Do you anticipate a similar mix also for us going forward?
Mix going forward. No, actually going forward, I expect more of the conventional orders coming in, which last several quarters was subdued. So as a percentage, we may see a lot more of conventional orders. But having said that, the growth of the specialty products relative to conventional will also grow. But it's just that last few years we saw a huge drop in the conventional orders that will sort of come back,
Okay, got that.
Just to sort of explain it just from a slightly different angle is that you have a certain quantity of HTLS, OPGW, etc., which is already there in this order book. So that quantity is likely to be there and grow because the trend is of a lot of these getting finalized. At the moment, there is less conventional conductor orders in the order book. That will go up. So the percentage may reduce of this from 54%, but the overall HTLS and the premium product as a absolute number will not necessarily go down by that much. It will still continue to grow. So I hope that kind of puts it in the right perspective.
Yeah, I got that. Thank you. Like Divakar sir mentioned that this pending order book will be executed in the coming next 9 to 10 months. So is it fair to assume, and given that at this quarter's revenue, almost 44-45% of the revenues are contributed by the premium. So is it fair to assume that at least for the coming 2-3 quarters, the EBITDA per ton will be similar to what we have delivered this quarter?
No, the EBITDA per ton will go down slightly because as Chaitanya mentioned earlier that some of this conventional conductor execution is going to start from Q4 onwards, which is also a part of this order book. But it will be well over that 12,500 rupees per ton, which is what we are targeting. So what you will see is that the per ton may go down, but the total volume will go up.
And total EBITDA will also go up, and the bottom line will go up. But the EBITDA for the conventional conductor is lower, and that's why it will bring down the overall EBITDA.
Per ton.
Per ton.
Got it. Yeah. Lastly, a few data points. Can you just share what was the LC number for this quarter and the net debt position for this quarter?
The long-term debt is 250 crores. Short-term is 51 crores. Cash and cash equivalents is 465 crores. And the LC, interest-bearing LC, Forex is 996 crore and domestic is 1,123 crores.
Yeah, that's it from my side. Wishing Divakar sir all the best for the future.
Thank you.
Thank you. The next question is from the line of Vikas Kamani from Carnelian Capital. Please go ahead.
Hi Kushal, hi Chaitanya.
How are you, Vikas?
All well, how are you? So Kushal, I had a slightly broader question. See, if you see from 2017 to now, broadly we are, in a broader EBITDA range of in and around 450 to 500 crore, right? Now I think there's a very big, and rightfully I think there has been a very, very sort of muted investment cycle and, environment was not so good. But with the environment changing substantially, I think first of all, your view on that, how are you seeing environment over the next couple of years changing? And if that were to sort of happen, what does it mean for Apar, where we can be in, let's say, next 2-3 years? Because we have also done capex in the last 4 or 5 years, significant capex of 400 or 500 crores. So how do you see that, keeping in mind broader environment?
Yeah, so Vikas, in terms of the way we look at it is that in the next few years we will see certain segments, growing at a fairly good pace, especially those which are, falling into this whole energies that are being added on this whole ESG side. You will see a lot of wind power getting added. You will see solar continuing to get added. Transmission lines also getting added, evacuating power from these into the grid. So, plus you will see this optical fiber, because today data is like the new oil. So all the lines are also having, this fiber optic core in it, which is in the OPGW. So we see the conductor side of the business continuing to, at least the premium offerings continuing to grow. Our strategy on the conventional conductors is that we want a certain minimum margin. If it doesn't fall into that economic model, we'll allow the business to drop. But the premium offerings which we have, we expect that to continue to grow on the conductor side. Similarly, on the cable side, we are actually very bullish on the cable business, because two areas. One is that you've got a lot of infrastructure that's getting added in India as well as overseas, and the two markets that we have targeted is the US and Australia, where there was a very, very strong presence of Chinese cable companies, and the customers are also very interested in diversifying their sourcing base. Both of the economies are actually very advanced in terms of, the kind of requirements they have, quality standards, etc., etc. So we see again electric infrastructure on the cable side driving, one side of the business. Secondly, as a carbon footprint has to be reduced, you will see the entire public sector, or not public sector, the public transport sector growing. So there will be more trains and networks. Every city in the world will have metros. We have a presence in cables on the metro side. In fact, the Australia jobs are running in, the main customer there is Sydney Metro, and they're rebuilding and expanding their metro systems there. So we expect this to happen across geographies around the world, because the carbon footprint of an electric run metro is much, much lower than if people are using any other form of transportation. We also see this EV and electrification coming up, especially in urban centers. And on the cable side, we have not only a focus in terms of cables that go in, to the charging infrastructure, but also we've developed a set of cables for batteries as well as electric vehicles, which we are in the process of getting approved from various manufacturers in India, as well as we started showcasing the product to even some people overseas. So the bottom line is that both of these areas on the cable side will grow. The third dimension that we are looking at on cables is to grow the LDC business. So some of our competitors who've come up with better numbers, not only in terms of more steady profitability, but also a better cash flow cycle in cables, have had a large LDC business, which is a building wire and light duty cable business. So that's something which we are growing. We have a good offering in the form of E-beam house wires, which are the best in class in terms of short circuit and other technical performance. And so we have seeded it in certain markets, have been successful there, and now have been growing. So by FY24, you will have like pretty much a pan-India presence, on the LDC side. So these are some of the areas where, I see big growth taking place on the cable and conductor side. As far as our oil business is concerned, our lubricant side of the business continues to otherwise gain in market share, the industrial and the automotive side. And then if all this electric infrastructure comes in, then transformer oil will be an automatic beneficiary.
Right.
So, to answer your question where you're saying what will happen to the EBITDA of the company. So the EBITDA of the company can easily grow 15-20% a year if these things fall in place.
Mm-hmm. And for this, I think most of the investment is in place, right? We don't need to do anything significant capex.
We have done a large amount of the investment. So the investment going forward, our lubricant business will require almost just maintenance capex. Conductor business also doesn't require a very large amount. It's just debottlenecking, and as the product mix changes, then you've got to make certain investments to be able to cater to specifications that utilities come up with, but no big ticket item. It's the cable side where we will continue to invest, but you will see again there also a drop. So the free cash flow in the company should start substantially increasing from FY23 onwards. In fact, even this year there is a more positive cash flow that will come compared to previous years, even though we have made these investments because of the discipline on managing cash.
Right. And the EBITDA margin, should be. I mean, if all these things happen, then EBITDA margin also will tend to expand, right? We should probably go with the more value-added stuff more towards 8-9%, or will remain stuck in 6-7% kind of range.
So percentages are a little tricky for us to be able to take a call on. But if you look at the absolute rupee value of EBITDA per ton or per KL basis, and you aggregate that, then that should go up by at least 15-20% over what we will see this year. We are already at 393 crores in the 9-month period. It will be more than proportionally, it will grow in the fourth quarter, and then you can see 15-20% growth in the years coming after that.
So in a 2-3 year time frame, we can kind of have a good shot at hitting 1,000 crore EBITDA basically.
Well, 1,000 is a little. I wouldn't be hanging my hat on that. But as I said, 15-20% growth is very much possible over the next couple of years. So we'll be at close to 500 crores this year, and then you get to 600, 700. That sort of progression.
Yeah. Okay. Right.
Thank you. The next question is from the line of V. Kandaswamy, individual investor. Please go ahead.
So now that the base oil prices have gone up, obviously transformer oil prices have all gone up. You have inventory of base oil at lower prices. So do you expect a substantial spike in the per ton margins in transformer oil in the current quarter? And whatever is the inventory you have, how long it will suffer? Because you have a low cost inventory. That will have a higher EBITDA margin, obviously. So with the current stock, how many months of requirements will be taken care of? That is my first question. I'll come to the next question after your answer.
So we have, if you look at the pipeline which is there between the inventory which we hold in the tanks and what is on the waters arriving into India, the inventory that we have, which is already firmly priced, is a little over 2 months. So now I don't see us being able to make some sort of a massive windfall with this, because we are not the only guys holding inventory. Even competitors are holding inventory, and it takes time to go to all the customers and increase prices. Some of the sale takes place against price variation clauses that EMA has. The point I am making is that we don't expect that with this increase in the crude, we will have a very unfavorable situation where there is a big price leakage that takes place, where your cost has gone up and the customers haven't increased the prices. Now this sort of scenario has happened in the past, but we don't believe that it will happen this time, because we have these 60 days worth of stock with us, which is sufficient time, I believe, to be able to get prices adjusted in the market.
So on this segment, sequentially, we can see better margins. Can I put it that way?
We will see a steady market. So you will see, the EBITDA per KL will be at least in the same vicinity, even though you will have an inflationary environment.
Fine. The second question is on this cable. Now that the budget has said about optical fiber cable networks to villages, how big is our OPG network so that we can cater on a very large scale? Are we equipped for that, or we are only a niche player? We have very high margin in OPG cables. That's all. Or we may be able to scale up significantly in line with the government plan and make the optimum benefit out of that.
So so there are two separate products. OPGW is one product line and an optical fiber cable is another product line. The OPGW is basically an earth wire that runs on a conductor network that carries a fiber optic in its core. So companies like Power Grid, railways are the people who adopt this OPGW as an earth wire. Otherwise, in the old days, the earth wire was just a steel wire, galvanized steel wire. Now, in this case, it's a galvanized steel wire with a core in it, which is fiber optic. So it is a niche product, but today every new transmission line is being looked at with an OPGW core. And so the market itself is expanding. The market size, as we mentioned on previous calls, could expand as much as about 50,000 kilometers a year. And we have capacity in place to be able to pick up about at least 25 to 30% of that market share. So you will see that as a steadily growing line item in our conductor businesses sort of revenue. The other big competitor based in India is Sterlite, which is now Sterlite. It's under Sterlite Transmission, which is part of their power business. So they are the largest manufacturer of fiber optic cables as well as the optical fiber in the country. So obviously they do have some benefit over competition. But we expect and we are targeting 25-30% market share at least in this going forward. And requisite capacity is being expanded right now. That was what I mentioned earlier in the call, so that we are in a position to cater to these increasing requirements.
So will we maintaining our market share or will we be able to increase our market share in the growing market?
So the current market share the market at the moment is relatively small. It's only from the last quarter that the order book of OPGW has started increasing. So our market share also has been increasing because previously this was dominated by players from China who used to import. But with the current tendering structure which is in place and the Atmanirbhar project, domestic manufacturers are actually benefiting from it. So our market share is relatively very low in OPGW historically. Now it's in that 25% range, and we expect it to be in that 25-30% range going forward.
So we'll be growing in line with the market.
Yeah. I mean, it will be growing faster than the market because we had like a 10% share previously. Now it will be in the 25%, 30% range.
Right now it is 25 to 30%. You are saying it will be remaining in that range going forward, and the market is also growing. So that means you are expecting to grow in line with the market.
Yeah, in a way, yes.
Fair enough. And the specialty oils, are we not focusing much on that, sir? That is where margins are much higher, no? White oils.
No, so white oils, the margins are, except for the high-end pharmaceutical range of products, white oils are the most commoditized of the offering that we have. So our focus is to actually grow some of the high-end transformer oil and our industrial and automotive lubricant side, which is where the margins are relatively better. And that is something that we have continued to do. So you will see that even in the 9-month numbers, the industrial and automotive per metric ton or per KL margins have been reasonably good, and now they are reaching a certain level of steady performance.
Between industrial and automotive, where do you see growth to be faster for your company?
Your voice is not clear at all. I'm not able to comprehend the question.
Yes, sir. Between industrial oils and automobile oils, where do you expect faster growth for your company in terms of sales, in terms of margin?
So both of them go on different tracks. The industrial oil consumption increases with the industrial activity in the country. So more manufacturing taking place, automatically industrial oil consumption is higher. The automotive side is fundamentally a function of how much grows on the commercial vehicle side and to some extent on the passenger car side. So our sense is that both of them will grow. Industrial is something that we would expect, where the longevity of growth is much higher, because as more and more industrialization in India takes place, more and more automated manufacturing takes place, the amount of industrial oils required will go up. If you look at the pecking order, they are actually higher in the pecking order in terms of industrial oils compared to automotive. Where on the automotive side, there are a number of big MNC companies also like Valvoline and Total that are present, whereas they have a much smaller industrial oil offering. Same thing with Castrol. Castrol is very, very strong on the automotive side. They have a smaller industrial oil offering. So our expectation is that the two are mutually exclusive. If you try to grow industrial oil, that doesn't take away anything from you growing automotive oil. So we are pushing both parallelly.
My question is slightly different. I'm just asking whether now you are able to grow faster in industrial where you already have an edge, or in automobile where there is intense competition as well. I mean, both are not complementary or supplementary. They are in two different directions. I do agree with you. But where do you see growth to be faster?
We are growing at almost a similar pace, because on the industrial side we are focusing more on specialized products where the margins are higher. So the sales cycle is a little bit longer. In the case of the automotive, our market share is relatively not very high, so there is a lot of white space available for us to fill in. So I think both of the products will grow at a similar pace.
Fine, sir. Thank you. I'll come back.
Thank you. The next question is from the line of Pawan Nahar, individual investor. Please go ahead.
Yeah, thank you, gentlemen. First, wanted to thank and best wishes to Mr. Diwakar for all the years and the amount of learning and patience with which he answered. So thank you, Mr. Diwakar. Thank you very much.
Thanks, Pawan.
Yes. Second was Kushal Bhai, Chaitanya Bhai, I just wanted to ask a few questions. One was, there was a mention about the fourth quarter conductor volumes. Was it 30,000 or 40,000 ballpark?
30,000.
30,000. Okay, got it. Then the other thing I wanted to ask was, the oil business overall volumes have been pretty robust in terms of growth this year, right? So for next year, what do you think we could do in terms of volumes and per KL? Of course, we'll revisit it later given so many changes, but I'm just trying to have a breakup.
So Pawan, in the oil segment, there are certain groups where we want to target a systematic growth in volume. So on the industrial and the automotive side, we are targeting a 10% volume growth, to take place between the domestic and the export market. On the transformer oil side, we would see at least, my expectation is that there should be at least a 10% growth, because we've degrown from previous periods. And there is again a mention in the budget. I don't know what the fine print will be and how soon it will be rolled out, but as the privatization of DISCOMs takes place, there is a lot of improvement that is required on the distribution transformer infrastructure. So when that kicks in, you will see a step function growth happening there. We continue to win more business overseas. At the moment, where the difficulty of predicting the growth is that the freight costs have become very high to certain geographies where, we were seeing increased market share. Like for example, in Australia and Latin America, we were growing our market share in transformer oils. Today, the freight from India or from Jebel Ali, from Mumbai or Jebel Ali, is almost 30-40% higher than the freight from a US port or a European port to these locations. I guess largely because the reverse haul is cheaper, with a lot of containers stuck in these places. So these are, the area. Notwithstanding that, the areas where we are focusing on growth is the auto industrial side and the transformer oil side. The white oil is a little bit of a filler. when it tactically makes sense for us to sell product and we make the minimum margins required, we will then push the product. But we just don't want to push volumes, just to hit a total number of kiloliters that we end up selling if we don't make, the right margin levels.
Okay. So we've done about 345,000 KL in the 9-month period, right? Which is 17% up YOY. I understand last year was a decline, right? So we are pretty much, coming back at 10% more than, let's say, FY20 levels, right? So next year on this 450, assuming that, the trend continues and we do about 450,000 KL this year. So can we, again, I understand that there are challenges and in fact, there are serious challenges and despite which these numbers are coming. So that is, again, once again, a compliment. But can we assume like a 10% growth? So ballpark, let's say 500,000 KL next year?
So, let me answer the question. I may not answer it exactly, but, we are, for next year's plan, we are targeting at least a 10% growth in our auto industrial and our transformer oil side. So these two would contribute to approximately 65% of the revenues of the company. So in that 65% by volume, you should see a 10% growth. For the remaining 35%, we will take a tactical call because freight and other things play an important role on the white oil and process oil side of the business. One other segment that I didn't mention where we are seeing growth taking place is on the automotive side. Again, this year the automotive numbers are slightly subdued. As you see more delivery of passenger vehicles and commercial vehicles taking place, our rubber process oil segment will also automatically grow. Because there are some product offerings which we have there where we have a very strong market share and a position. So if the market category grows, automatically we grow there.
Got it. So basically, let's say, so overall, and in terms of per KL, do we think we can maintain this number next year? Ballpark 6,500?
Our target is to be able to maintain it. 6,000. 5,000 is like a minimum that we'd like, but I think at the moment we are upward of 6,000 and we would like to be in that ballpark.
Okay, thank you. Then the other thing was...
The one last thing I'd mention, Pawan, is that besides the per KL number in our oil business, the free cash flow coming out of the oil business will continue to improve year on year because there's very little capex investment that's required.
Oh, absolutely.
So, money that's getting generated is going to be, and we intend to use some of that to improve the LDC business and things like that, which are, and the retail side of our automotive business.
So let me then use this absolute number. You've done 9 months, 220 crores of EBITDA in the oil business, which is the largest segment for us now at this moment. And so we can
Yes.
And but for next year, right? What is our best guess in terms of volume? So from let's say about 100,000, 105,000 tons this year, where could we be next year? And in terms of EBITDA per ton. So Chaitanya, if you want to answer that.
Be more like 120,000 tons or so for the year.
Okay.
And in terms of EBITDA, as we've been mentioning, it should be, north of 12,500 rupees per ton.
Okay, fine. I'll take that number. Then, Kushal bhai, I mean, for the cable business, somehow in my notes or my Excel sheet, what I see is that we had, I presume, an aspirational number of 2,500 crores of revenues. Was it for FY23?
Yes, so this year we will cross 2,000 crores in revenues.
Right.
And for FY24, our expectation was, to target a growth of at least, about 15%. So you would be in the range of around 2,400 crores, based on the current commodity price level, with an EBITDA which is, at least in the 8 to 10% range on that number. So if you take an 8% on that, you're looking at
190 crores. 190, 200 crores. Yeah. Right.
And that's why when Vikas had asked the question earlier, this thing was that 600 crores of EBITDA is what one can look at.
Absolutely, that's the number even I'm getting after doing this math. And then the other question I would ask is.
Sorry to interrupt, Mr. Nar. Maybe request.
No, I'm pretty much done. So thank you once again, and looking forward to reaching that 20% ROE number. Thank you so much. Best wishes.
Okay, thank you.
Thank you.
Thank you. The next question is from the line of Pratiksha Daftari from Equitas Investments. Please go ahead.
Thank you again for the opportunity. Just wanted to confirm the LC link borrowing.
The Forex LC is 996 crores and the domestic LC 1,123 crores.
1,123 crores.
Yes.
Okay, 996 and LIBOR link is 996 and domestic is 1,123 crores.
Correct.
Okay, all right, thanks.
Thank you.
The next question is from the line of Praveen Agarwal, individual investor. Please go ahead.
Hi. I have a couple of questions. One is on the cables side, right? Say a couple of years ago, we were looking at, say, around, we were making 10% around EBITDA margins. And I understand that at currently in the market, there's a lot of competitiveness and there's not offtake for some type of cables we make. But do we think that in the next, say, couple of years, we'll go back to that 10% EBITDA margin range on the cable division side?
Mr. Agarwal, our sense is, as I mentioned while answering Pawan Nahar's question, that our target is to get to 8 to 10% with the current values of metal and polymers, etc. One thing that actually has led to this getting reduced also in this year is that there are certain components like polymers, for example, which are not necessarily covered under a price variation formula. You never had polymers going up. In this year, in the last 12 months, PVC and some of these XLP compounds and all have gone up by 90%. So whenever you have a bidding kind of environment, you would have this sort of a pressure taking place because there is no formula to pass on the polymer. So the way we are mitigating it today is that we are quoting only for shorter periods of time. And if there is a longer period of time, we are asking for a new variation clause to be put in or then desisting from it. So longer term, our expectation is that with the current levels of polymer and metals, etc., targeting around between 8 and 10% EBITDA on the cable side. And that possibility can come up provided we end up getting a steady state of business coming on the wind and defense and some of these segments. We've had a very low proportion of that in the last 4 or 5 quarters, but from the Q4 onwards, it's showing a higher percentage based on inquiries, order books, etc.
So with the prices going up, let's say if you were running our plants for the cable division at 100% capacity, what would that translate to revenues? If, say, for a quarter we run that at 100% capacity, what would that translate to in terms of revenues?
So after we complete the expansion on the windmill for the cables that go into the wind, etc., then you're looking at around between 2,700 and 3,000 crores with the current mix.
Understood. Thanks for that. See, the other question I had around the defense revenue. I understand over the last few years that's something which, while small, it has grown quite rapidly. I remember sometime during last year's call, we mentioned, if I remember correctly, around 170 odd crores. I thought is some in that ballpark we were making for defense.
No. Defense, we had reached up to about 40 odd crores on the defense side. And this year, if you look at, let me just pull out the numbers here. So we were at, we will get to, around 50 crores in FY23. So this year the number is relatively very muted because most of the business is coming in only in Q4 on that defense side. It also depends on the speed with which, especially, you see the intensity of cables is highest in the Indian Navy. So depending on the rollout of submarines and frigates and all these sort of things, the cable requirements come up. So at the moment, there are some very aggressive plans in place, but these need to fructify. One of the things that has been brought up in today's budget is an increase in the Make in India portion of what the defense establishments buy. So that is being targeted to be higher than now. So, if those things happen, then, our cable requirements to defense also will start increasing. But I think FY24 will go back to around 50 odd crores. This year we will be in the range of around 25-27 crores.
Okay. Okay. My final question or point I want your thoughts on is targeting. We target EBITDA per kiloliters or EBITDA per ton in the conductor or the lubricants division. But let's say, I have a more theoretical question on this. Say, if raw material prices, go up by say 100%, and if we target the same EBITDA per ton or EBITDA per kiloliter, our return on equity will probably go down by half because our capital outlay will increase just double. So, is there any thought around that we should at some level also target some absolute EBITDA percentages levels for each division rather than just only looking at per liter or per metric ton as the case may be?
Agarwal, what we end up doing when we do our internal costing is that we target an EBITDA per ton, but then depending on the finance cost associated with the execution of the order, there is a modification that we would make as the quote for it. So if the prices of all the metals and everything go up higher, then the EBITDA per ton that we would target from that customer would be adjusted, upwards to compensate for the cost. So here what has been happening today is that as the metal prices etc. have been going up, but the interest cost has been lower simply because of the lower interest rates which are involved. So that's why we're still seeing 12,500 rupees a ton. If the interest rates go up and the metal prices also remain elevated, then obviously we will revisit that number to make an adjustment for the finance costs involved in running the business. I hope that addresses your question.
Yeah, that addresses. So 15 to 20% ROE is something which we, the aspirational number, we continue to target that in the medium term.
Everything is to be worked backward from that. That is the target. And then based on that target, we are trying to work backwards.
Thank you. That's all from my
side. 9 months, we are at 15%. 15% ROE. And I think the fourth quarter hopefully will be a little bit better. So we are in that 15-20% ballpark number that we are talking about.
That's it. Nothing else from my side. Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to the management for closing comments.
Yeah. Thank you. I thank you everyone for participating in our Q3 FY22 earnings call. Just as closing remarks, we are reasonably optimistic in terms of the way we see, business going forward. hopefully with Omicron not creating as much of a disruption as when it came on. I think the fourth quarter of this year should be a little bit more predictable in our execution, and we go in with a reasonably healthy order book in our cable and conductor business as we enter the next financial year. The oil business also, as I mentioned, is on a fairly strong wicket and should deliver good free cash flow. Also, you will see a lot of more branding going on, at least on digital media as well as in BTL activities in the next 2 years around our offerings of LDC and lubricants. If those offerings are successful, then that will improve the earnings quality of the company and hopefully the valuations as that percentage grows. So with that, I just like to thank everyone and publicly thank Mr. Devatkar for, he's still with us for a couple of months, but this may be his last earnings call in which he will be taking an active role. So thank you, Mr. Devatkar.
Thank you.
And thank you everyone for your time.
Thank you. Ladies and gentlemen, on behalf of Apar Industries Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.